Have you ever wondered why your investments don't grow like you hoped? It's not your fault. In this video, we'll be sharing the behavioral traps and process flaws that cause most average investors to lose money fast in the stock market. Lack of education and understanding. One of the main reasons the average person loses money quickly when investing in stocks is the lack of proper education and understanding of how the stock market works. For many people, stocks seem risky and unpredictable from the outside. Without taking the time to truly learn the basics of investing, common stock strategies, and how to analyze companies, it's easy to make costly mistakes. Many jump into investing with only a surface-level understanding they got from friends, family members, or quick online research. But truly comprehending market volatility, diversification, dollar-cost averaging, and valuation metrics takes significant study. Without grasping these foundational concepts, it's difficult to avoid behaviors that invariably lead to losses, like panicking during downturns or chasing hot trends. Poor asset allocation and diversification. Many casual investors lose money because they fail to diversify their portfolios across different asset classes and securities properly. Instead of a balanced, blended approach, they concentrate too heavily on just a few higher-risk holdings. This could mean investing the bulk of their money in speculative tech or biotech stocks, meme plays, penny stocks, or cryptocurrencies instead of broader index funds and ETFs representing the total market. Over-reliance on just one sector leaves their nest egg vulnerable if that area suddenly falters. Lack of international exposure also forgoes participation in overseas growth. A well-balanced, globally diversified portfolio spread across large small-cap stocks, value growth styles, bonds, and alternatives provides a much-needed buffer against unwarranted volatility and company-specific risk. But those without guidance invest blindly with too many eggs in too few baskets. Chasing momentum and hot tips. Closely tied to relying too heavily on a narrow selection of securities is the common tendency to chase the latest market momentum and tips from friends without vetting them. Getting in at the tail end of a parabolic move is usually right before major losses materialize. Yet the hype of seeing others score quick doubles or triples often cloud rational thinking. Whether it's options trading, swing trading penny stocks, or piling into the newest cryptocurrency following a viral Reddit discussion, average investors have a hard time resisting euphoric groupthink and FOMO. When a tip reaches their ears, the smart money has already taken profits, and more often than not, assets cooling off the fastest in the short run due to overextension and frothiness. Without discipline and patience to let winners truly run their course, or the experience to know when trajectories become unsustainable, casual investors end up holding the bag when manias burst. Maintaining a long-term horizon focused on sound fundamentals protects from these speculative booms and inevitable busts. Chasing past performance. Another major pitfall is believing past returns justify an investment rather than understanding why they occurred. Just because a particular fund, stock, or manager has trounced benchmarks for the last 3 or 5 years does not guarantee that strong relative performance persists. Chasing returns is usually a recipe for underperformance over the long haul. Periods of outperformance are rarely repeatable or sustainable without fundamental advantages that may erode or disappear with changing industry dynamics and competitive landscapes. Things like concentrated positions, temporarily favorable policies, unsustainable growth, or being in the right sector at the right time often fuel short-term alpha that proves fleeting when conditions shift. By focusing so heavily on the narrow rearview mirror of recent numbers, casual investors try to time the market's aging business cycles, an impossible task even for professionals. A prudent strategy emphasizes consistent strategies applied through changing conditions instead of chasing what was hot yesterday. Overall, portfolio construction with appropriate diversification and discipline serves average investors much better than infatuation with today's leaders. Lack of patience and staying power. Closely linked to panicking at the first signs of underperformance is a lack of patience and an inability to stay the course long enough for strategies to work. Successful investing requires weathering inevitable short-term volatility and downturns while maintaining a perspective on long-term objectives. Yet the average casual dabbler lacks the intestinal fortitude and discipline to hold positions in periods of perceived discomfort and short-term losses. Whether rotating out of an underperforming active manager after just a year of lagging the benchmark, or bailing on a sector when it falls out of favor for a quarter or two, impatience usually means rotating assets at precisely the wrong times before recoveries take hold. Chasing returns this way almost guarantees buying high and selling low over time. Without an unwavering ability to look years or decades into the future, normal short-term gyrations induce knee-jerk reactions that rarely work out well. Compounding positive long-term results requires placing appropriate allocations and sticking to them regardless of short-term performance. Statistical probabilities over many market cycles heavily favor those who maintain prudent broad diversification rather than frantically try to reoptimize constantly. Lack of a written plan and process. Another root cause of lackluster results is failing to establish a clear, coherent, documented investment strategy and sticking to it through discipline. Without explicit guidelines and parameters, investing decisions default to emotion, reaction, and impulse rather than a systematic process focused on goals and objectives. Key aspects missing from most casual investors' approaches include defining an appropriate risk tolerance and blending of assets, setting target portfolio allocations across sectors and styles, determining entry and exit rules adhered to consistently, picking investments aligned with goals and criteria, scheduling rebalancing, setting sensible position sizing based on capital, and stress testing under adverse scenarios. Without written rules holding them accountable, average individuals invest haphazardly, subject to whims of news headlines, friends' anecdotes, or what's performing best currently. Often, they think they have a plan, but instead make it up as they go with no repeatable methodology. Developing, following, and periodically reviewing a clearly defined strategy brings much-needed rationality, focus, and discipline to the decision-making process. Poor position sizing and leverage. Casual investors also tend to make sizing errors that amplify risk and potential for loss. Whether too small or too big, position weights matter tremendously to long-term performance and compounding. Taking on excessive concentration or leverage is a surefire way to undermine returns regardless of picking correctness seriously. Common mistakes include overweighting a few preferred stocks within regulated IRAs or 401s instead of maintaining appropriate diversification for that account type and goals. Others may put far too much of their net worth into just one or two speculative plays, fueled by hopes of lottery-like payoffs instead of prudent position guidelines. Leverage in the form of margin borrowing or derivative contracts multiplies risks exponentially when used without a disciplined process. Yet chat boards glorifying 10-baggers entice novices into betting mortgage money on Elon Musk's tweets or taking out six-figure loans to trade options. Even buying shares on margin imposes forced selling during downturns. Lack of tax efficiency. Another issue eroding average investors' long-term performance relates to avoiding consideration of taxes in their strategies and decision-making processes. Few casual dabblers employ prudent tax loss harvesting, limit realizing short-term gains, thoughtfully donate appreciated shares, or opt for the most tax-advantaged account types. Ignoring the permanent drag of unnecessary taxation guarantees lower compound returns over decades. Failing to offset realized losses against gains or donate appreciated shares at death leaves significant money on the table with each annual filing. Thoughtlessly trading in taxable accounts subjects ordinary income treatment versus long-term capital gains rates. Not taking advantage of available tax shelters like 401ks, IRAs, and HSAs misses out on compound growth, accelerating undiminished for decades. Choosing taxable brokerages or mutual funds over equivalent ETFs burns money needlessly year after year. Lack of periodic review and adjustment. Another behavioral tendency causing average investors to underperform is failing to periodically review their portfolio allocation, holdings, and performance relative to goals, and make necessary adjustments over time. Markets, economies, and circumstances constantly evolve in ways requiring reassessment and responsiveness. Yet inertia and procrastination prevent revisiting investment plans, rebalancing to restore desired targets as positions drift, culling underperformers, and potentially upgrading or modifying the strategy as needed. Tax loss harvesting opportunities go unused. Company fundamentals change, but positions persist without scrutiny. Risk tolerances potentially evolve with life changes, but the portfolio stays static. Even passive buy and hold index investors should rebalance annually and check their allocation mix remains suitable. Active managers deserve review after meaningful underperformance rather than endless charity. Strategies appropriate a decade ago may need tweaking today. Don't miss the next money move. Hit like and subscribe buttons and join the squad. And let us know about your thoughts in the comments section below.